So a lot been going on lately, and I think the thing that we want to talk about more than anything is energy and yields. And at least myself, I haven't asked Kashop if that's the biggest thing on his mind, but I think for myself, like I can certainly say, looking at bonds, yields, and I keep getting told wild stuff, Kashop, which is that everybody thinks yields are going higher and they're going lower. I have not seen that sentiment anywhere. Like people keep saying, Jason, everybody thinks yields are going higher. I'm like, I thought, that was kind of just me, maybe you and Sam, out of anybody I know. And looking at it online, whether I'm going through Bloomberg, whether I'm going through Twitter, whatever it is, I haven't seen anybody talking about the fact that yields could go higher here. And once again, we have to also identify what I mean by that. So what I mean by that is I think that the Fed rate will go lower. I'm not debating that. I am debating the fact that the long-term yield, you might see it follow for a little bit, but it isn't going to follow for long. Like you might see this range, and I already have a chart of TLT up, so let's pull that up. You might see this range kind of get back to the top of the range again. That would be, around that. I think it was around $100 level. Can't remember exactly where it is on TLT, but basically getting up to that side of the range or another 52-week high rejected or something like that. I think that's possible. Maybe even a rally even higher than that. But in the long run, if I'm looking at it over, a multi-year period, I definitely think lower. And even in the short run, I don't even know if it's going to go that high right now and follow the Fed rate. I think it could also roll over here, and there's a lot of reasons why. But everybody keeps trying to buy this thing. They're like, yeah, it's time to buy TLT. And like I'm not saying that bond prices can't go up. And Kashop's known me for a long time, and a lot of people. The first thing anybody ever knew me for was bond trading. Everybody thought I was like a bond guy, which I was never a bond guy, but I always had like a good feel for what the bond market did. I understood the structure of it and the inside of it, so I could teach people how to trade it. So people always thought of me as a bond guy, and then I basically just rode the trends, and everybody thought I had this magical predictive ability. I didn't. I just understood the fact that when bond prices go up, they tend to trend nicely. When they go down, they tend to trend nicely. And I understood the macro environment. And the macro environment right now isn't telling me that the long bond should go up. Everybody keeps talking about, well, look at the market. The market's saying that the long bond should go up, like TLT should go higher. And I think that that's a kind of a ridiculous thought, considering what we've been seeing. International stocks are leading. That's not something we see in like lower yield environments most of the time. The dollar is falling. It's not something we usually see in an environment where yields are just, steadily going lower and we see everybody excited about the Fed and the whole world is racing to the bottom. So they're all outpacing the Fed rate. That's not happening either. We're not in, all these negative yields all over the world at the moment. And then the Fed is just the cleanest dirty shirt in the bunch. There's a lot of places to put your money now, not to mention the way the market is looking. If you're looking at metals and mining and saying that this is obviously very positive for yields going lower, that's a ridiculous thought as well. Other people have been bringing up another thing, which is energy. And they're going, look, energy is saying that yields are going lower. And this is when my mind just gets blown. I'm like, okay, like I understand like some of these feelings, like, yes, if you want to talk about the banks, they've changed a little bit the structure and so on. And yields going lower might help them at certain points. But what we're also talking about here and what's really important, and if you want to be a bond trader and understand how to do this well, you have to understand the yield curve. Like understanding the yield curve is everything. So if you're looking at the 2-year or the Fed rate to the 30-year or the 10-year, meaning, the 3-month rate, which is the Fed rate, all the way to the 30-year yield, which is what the TLT is tied to. When you see that steepening, that's called a bull steepener. When you see a bull steepener, that means that liquidity is loosening up, that banks should do well in that environment, and that has nothing to do with whether the long bond yield is going down or up. That is if the Fed rate is outpacing the long bond yield. That creates a lot of liquidity in the market. That's very good for the banks. That's the type of environment that'd be good for the banks. Long-term yields, though, they move with growth, but most importantly, right now in this environment, they move with inflation. Inflation is the most important thing that we have to continue to discuss here because inflation is sticky. The one thing that nobody's going to debate here is that inflation has been sticky. You can, go against me and say, hey, we don't have inflation anymore or anything, but like it's not to these crazy levels. It doesn't keep running higher and so on. Like you want to debate that, fine. But the one thing you can't debate is that inflation has hung around. Whether you're in the United States, whether you're in Europe, Asia, South America, wherever you're at, inflation has hung around at elevated levels. So seeing those elevated levels of inflation, I can't see any reason to really think like, hey, I want to start stuffing, 20% of my retirement in TLT. It sounds insane. Why wouldn't rather you would probably want to stuff 20% of your retirement in something like gold miners, and so on, and you make a lot more money. And even if bonds start to move higher, those will probably outpace it. But what are your thoughts on that? I keep having these conversations and I'm just blown away by some of them. Now, granted, I'm not saying like I'm always right, but I am saying the one thing that I know for certain in this environment is that the yield curve will continue to steepen.
So if you look at, let's just take the argument that yields are going lower and the market is starting to front run that story. So in that case, what would we see? We would see dividend stocks start to take off. So something like the Nobel ETF, the S&P Dividend Aristocrats ETF, we would start to see that take off. We would start to see defensive plays like consumer staples, healthcare, all of this, you would start to see that take off. And what are we actually seeing? The best performance year to date, Greek stocks, Chinese small caps, European financials, gold miners, and things of that nature. So completely nothing to do with defensives. So is the market really pricing in lower yields? No, it's not. Now, if you look at an environment like 2019, it was possible to make the case that yields were going lower, and they actually were. And there was a time when, even though gold miners did well, you also saw the defensives do extremely well. That's not the environment we are in. In fact, the defensives are getting wrecked. Now, of course, you have the outliers like Walmart and Costco, and they are making a lot of money because uh, the the wealthier Americans are switching to Walmart and Costco, so they are doing well. But overall, if you look at it, the defensives are not doing well. In fact, they're getting killed by inflation. They're getting doubly killed by tariffs. So now, speaking of tariffs and inflation, now in an environment where so Trump has been president for close to 7 months now, and the tariff is only now starting to kick in. Now there's going to be court cases and cases at the WTO, and it's all going to get pretty messy. But all of this, what it does is when people see uncertainty, when business people see uncertainty, they say, we don't know how this will play out. So let us just cut down our ordering. Let us just cut down the inventory that we have. Now, one person's inventory is another person's revenue. So when you see this happen, someone down the line is taking a hit in terms of their revenue and they are cutting costs and so on and so on. And it just keeps rolling all the way down. Now, in this environment, why would you buy defensives? Why would you buy anything which is yield seeking? Now, you might buy utilities if you think, oh, AI data centers, they're going to consume a lot of electricity. Let's buy utilities. But that's a one off case. You're not really making a bet on yield. And like you said, with the bull steepener, so in a bull steepener environment, we will start to see business development companies will be in the news. So the last time the bull steepener trade was very popular in Wall Street, you had all these, I think it was Hercules Growth Technology or something, HTDC, then some Annaly Corp, and all these companies which were in that business of uh, borrowing short and lending long, and they were all making money, and those stocks were really soaring. And you had Lending Club was popular. So you're not seeing any of the signs which tell you that yields are going lower. So of course the trade can, maybe there's a chance it could work, but I'm not seeing any of the signs. And if I'm not seeing any of the signs, I'm not going to put on the trade. Now, I have a lot of reasons to believe, in fact, the opposite is going to happen. Now, what is the first piece of evidence for that? The first piece of evidence for that is when Janet Yellen was Treasury Secretary, she stopped issuing long dated debt. Now, if you believe that yields are going lower, which means the environment is conducive for long bonds, you would be issuing long dated debt. She did not do that. She had her reasons for that. And now the new administration is the same thing. They are also not issuing long dated debt. In fact, they are doing the opposite and they are doing buyback. So they are issuing short dated debt and using that to buy the long dated debt. So these are all signs that tell you no one really believes in a bull market in long bonds. So, given all the weight of evidence, why bother with long bonds? There are tons of ways to make money, there are tons of trades to take in this environment. And there is a particular trade which worked well for a long time, which made a lot of money for a lot of people, but that era is over. And later on today, we are going to talk about the high watermark for that era, the high point for that era when you had negative interest rates. So that was a different decade. This is a different decade. And what worked in that decade is not going to necessarily work in this decade. So just avoid long bonds and move on to the other trades.
Yeah, I think it's it's just everybody's always doing the last trade. Everybody wants to fight the last war. It's the same scenario that happens over and over again. If you talk to investors that traded, in the .com bubble, they've always been tech investors. They call themselves tech investors. They're going to be tech investors forever. Then if you go forward, you get into the 2000s, and then you got guys who are, I'm an international guy, macro guys start coming out, trend followers start to come out because they're finally having good returns. Like all of these people start to come out once again. And then you get into the next era, which is technology starts to take over once again. We have this crazy exponential boom in technology in the United States and the world globally. Like tech has just gone crazy. We're coming up with new things every day. AI is changing the world as well. Social media platforms became huge in the 2010s. Everything continued to just grow at this exponential rate. And then we got into the 2020s. And the 2020s happened. You still see this massive outperformance in things like commodities start to have this massive outperformance. Technology also had some really good performance years as well. But I think, the biggest thing about it is you'll see that give and take when cycles are about to change. For example, you go back to the 70s, you start to see that, okay, there starts to be this new move in the energy stocks, that are coming up, and gold and silver and all this were the ones that were really leading the way commodity wise for those years. And then the next thing you know, energy starts to move. And then you start to see materials and chemical stocks start to take over in the 80s. And that slowly like shifts from one thing to another. And I think that technology isn't dead. Don't get me wrong. I'm not saying like, hey, all the tech trades are done. I'm saying that it's changed. Like, what's changed about it is the fact that you will make a lot. Technology stocks aren't bad right now, but that's just saying it in a blanket statement. If we go overseas to China, yes, technology stocks are killing it. They're massively outperforming all over the world. If we're looking internationally, of course, we look in the United States, technology stocks are okay. They're doing decently, but they're not what we're seeing all over the globe. It's the same with bank stocks. Bank stocks look great, but it's not what we're seeing all over the globe. All over the globe, we're talking about, Alfonso and Sam keep saying, oh, Deutsche Bank's the best bank, just looking at a technical. And it's just like the craziest words, you could ever think to hear from somebody, especially for people like us who've like traded that era. But like that's, and not to mention Deutsche Bank was just garbage for many years after that. It just continued to be chopped around, hit to death. Nobody wanted it, and now it's just ripping, all the time, and it's leading the way. So my main thought here isn't the fact that you have to start thinking, anti-technology. It's that you have to start thinking globally. And when we're talking about bonds, we're just talking about, like, I love that you brought up the defensive aspect of it. The defensives are do very, because people think this is two different things. So sorry, I'm getting a little bit mixed up, but this is something that's important. people continue to always bring up to me the fact that consumer staple stocks do good in inflation. I always fight this tooth and nail because like that's what I do. I go back, I look at the regimes, I see what regimes things do well in, and I go, that's not true. They don't have the pricing power. And Kashab, without you even saying it, I know you're probably thinking like, think about the 70s. What happened to, you know, all the consumer staple stocks? Basically, you had meat prices going crazy. You had every commodity going crazy that they used to produce, whether you were a grocery store, a restaurant, whatever it was. And the prices for these things kept going up. And like, let's say you're at McDonald's, you're charging $1 for a hamburger. Let's say your cost to make that hamburger is 20 cents. And then your cost goes up to 50 cents. You can't just raise it to $2 very quickly and people just continue to buy it. You'd have to just eat some of that cost and make it rise slowly. So similar example, like the old saying about the frog in the boiling pot of water. If you throw a frog in a boiling pot of water, it'll just jump out. But if you throw a frog in a cold pot of water and then you boil it slowly, it will stay there and boil itself to death. It's the same thing for inflation. You can't just jump from $1, $2, $3, $4. So they just kept eating the cost. And it's the same thing that's happening at the grocery store. We talk about the meat prices all the time. Live cattle just continues to rip higher 3-4% every day. You're not seeing that show up 3 or 4% every single day at Kroger as well. It's not like a live ticker for them. So because of that, they have to eat the cost once again. So this eats into their bottom line. This is why a lot of consumer staple stocks, whether it's Walmart, Kroger, McDonald's, and so on, don't do well in those type of environments. And so now that we're heading in that type of environment, like I still think like the real trade here is international risk on. And getting into different areas. I think the other areas that we really like are looking at energy. You know, to me, it's the next trade is really energy. I think that's probably kicking up. I think the trade we've been in for a long time is the gold miners, the silver miners, the explorers. I have no reason to think those have to stop. And here's another thing we should talk about real fast before people, before we get on the next subject. We're talking about gold miners. Everybody keeps coming up to me, Kashap, and they go, Jason, gold miners, they have to stop for oil to move. And I always have that cycle chart, and I'm just like, why are you getting that from this? If you look at that chart, you'll see like there's plenty of times where oil and gold move together. There's times where they don't. And that's historically the way it goes. And sometimes, yeah, it's a give and take. Like, I think everybody's just looking at the last cycle and going, okay, gold stopped really in 2020 August, and then oil really took off at the end of the year and went up, and then gold kind of chopped sideways. And so they're thinking that's going to be the playbook forever. And like in a real cycle, like that wasn't a real precious metal cycle. That wasn't even a real oil cycle. That was just a cycle where these things caught nice bids. It was the bottom. We got a ton of money from the government, ton of money from the Fed, basically unlimited liquidity into the markets kind of coming day after day. And so obviously you saw pops in a lot of things. And one of those things was commodities, especially because of the supply issues. Now we're in a very different cycle. And the reason why I'm saying that's different is because silver miners and gold miners and junior miners and explorers are ripping like that. We didn't see that in 2020. We didn't see that in 2018 when we bottomed out. The gold miners did okay, but it wasn't something where they were massively outperforming. Now they're outperforming. So I think that, thinking about these two things separately, you shouldn't do that. Thinking about that bonds have to go with gold every single time is not the way to look at it either. Because that's the thing that everybody kept talking about in 2020. Oh, look, bonds rolled over. Therefore, gold will roll over, and gold slowed down, but it didn't roll over. And then bond yields kept going down, and then gold just kept ripping. I think that'll be the environment that we're going to see, which is the junior miners and oil and possibly explorers and so on continue to move.
So in 2020, if you look at gold, what happened was we had gold move from April to August. And it was right there somewhere around August where gold stopped working and Bitcoin took off. Now, that was the era also where you saw the speculative capital, which usually goes to the gold explorers and the junior gold miners. It went from the TSXV to small cap crypto. So you had a huge boom all across the crypto space. And I think that came at the expense of gold, which is why you see this relationship between gold and oil. But those circumstances don't hold true now. So I don't think it's going to be that way in this cycle. I think this is a cycle where everything can go up, and that's just because whether the Fed prints money or not, people are going to believe that the Fed is printing money. Now, the Fed stopped printing, I think, after somewhere after the Silicon Valley crash when they did the whole RRP drain, and then they had that bank term funding program which expired end of April last year. So since then, they haven't actually been printing money, but the market believes that the Fed is printing money. And more importantly, the commercial banks think that next time there's a crisis, just like Silicon Valley Bank, just like all the other banks, they will get a bailout. So it is risk on for them. So that's why if you look at the chart of bank deposits are all commercial banks, it just keeps going higher forever. If you just look at deposits at money market funds, it just keeps going higher forever. And that's because even though the Fed isn't actually printing base money, the market is doing it for them. And the market knows that if they get too far ahead and there is a crisis, the Fed will print enough to catch up. So it's like you're tethered to a rope, and you can go as far as you want, including falling off the cliff, because the moment you do, there's like a Superman waiting to come save you. And that's the Fed's role. So even though they may pretend they're not going to print and all that, when push comes to shove during a crisis, they will print. And the market knows that, which is why the money printing just seems to keep continuing. And it's surprising that when we think about bonds in this context, all that money, and it's only going to the money market funds, it's not going to the long end of the curve. Why? Is because investors are absolutely clear that the Fed can only control the short end. Now, when they try to control the long end and they do their operation twist, I think we are going to see Fed lose control over rates completely, because at that point it will become obvious they're just going to print, print, print. And speaking of that, Trump wants them to print, 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 and he is trying to sack governors so that he can kind of get the other FOMC voting members in line with his vision, which is like zero rates and QE infinity. So, do you see that possibility happening? So, you're a lot closer to it than I am. And so, I was just speculating that you scare enough governors. So, right now, he has two votes on the board, two doves, and then there's one vacant post. So, he can fill that in with someone who will cut rates. And if he fires Lisa Cook, the Supreme Court agrees, and that's done, then there's four. And with four, you can influence the other eight. So it would kind of be like a 12 angry men kind of scenario where everyone goes from no, we have to stay hawkish, to no, we have to get dovish because that's what the president wants. Do you see the Fed falling into that trap? It's the trap which leads to hyperinflation. So do you see that happening?
That's a interesting point, and yeah, I'm in the same boat where it's how can the Fed and like the way the Fed is today, the Fed in the 70s, 60s, way different. Not to mention how much market participants even cared about any of it. They didn't give a shit about the Fed at that point. Traders didn't care. It wasn't a thing where people were basically, there was economists and a couple other people, a couple traders really studying liquidity. But for the most part, most traders kind of stayed away from it. But now, kind of moving forward, we're in an environment where everybody pays attention to the Fed. Everybody knows that they control the short end of the curve, big traders at least. And so looking at the long end and seeing them come in for an operation twist once again, I think it's a bad idea. I don't even know if they're going to try it because it's such a bad idea. Because the amount of money they would need to really make that happen would be insane. So I just don't think that they can. I don't think they're in control anymore to the same degree that people thought they were. And so, like, I think we're seeing that already in the bond market. Like, this isn't the rate of change of bonds over the last few years. I think it's not this year, but over the last, I think it was from March 2020 to 24 was the biggest rate of change ever in bond prices. You know, we haven't seen bonds go down to that degree that quickly ever. And so we're having, 20% down years. I think in 2020, we were 20% down in TLT. I mean, these are things that just haven't happened historically, even though, yeah, bonds have gone up, they've gone down, there's been crashes. But I feel like they've really lost the long end of the curve. And I think now the long end of the curve's kind of just ignoring them. So if we get to the next chart, I thought this was interesting because of the conversation I had where people were talking about energy and bonds and how energy and bonds could, move together. I just have never seen it, like it's not impossible, but it's something that I've just never seen. Historically, most of the charts look like this, where they're almost completely inverse of each other. When you see basically XLE started hitting a new high and then it started consolidating, that was end of 21 through 22. It really just consolidated and went sideways. You see bonds start to consolidate and go sideways at that same point. I think if we're going to see this breakout in energy, let's say this finally happens, everybody's going, it can't happen. I still think that it can finally happen. And the people who are betting on it happening are betting on it because of lower interest rates, which I don't think that's the case either. I think the situation here would be, and this would be the surprise, and this is why I keep saying it's the surprise trade of the year because nobody's talking about this, which is what if bonds, what if TLT breaks down right here? Everybody's looking for this bounce. Even me, when I talk about it, yeah, it's possible. I think there could be a bounce coming in. But the surprise trade of the year, and because the market loves to make a fool out of as many people as it possibly can, it could break down right here and just go down. I mean, it's in a Bollinger Band squeeze. It has its lowest volatility in many years. The trend is down, obviously. Like, look at the chart. That's a primary downtrend. Short term, it's in a downtrend. Midterm, it's in a long trend or downtrend. Whatever you look at, it's in a downtrend. So if you're a technician, and this is the thing that I keep having the same conversation, everybody goes, well, bonds, they got to go up here. And I go, well, like if you were looking at a chart of, like you flip it over, look at the yield chart. You're looking at a chart of NVIDIA and you're saying, oh, there's this huge flag in NVIDIA. It could go higher. You would think that. It's the same thing if you were looking at a chart of the S&P 500. You're looking at the S&P 500. It's going sideways. It's consolidating. It's in a massive downtrend. You wouldn't start betting, unless you have some very good reasons. You wouldn't start betting on it going up here. And I think it's the same for bonds. Like everybody's betting on it going up because it's low, it's cheap. As we know as traders, cheap can always get cheaper. And so I think that bond prices are probably headed lower. That's the call I continue to make and I think could happen. I still think, now that energy hit a new 100-day high, now I'm looking at a 52-week high coming up soon. We'll see when it hits that. But when we start to hit those levels, like this thing's really going to trend. I think energy is probably going to break out at some point and then probably not look back. And so you brought some stuff here. So bond markets have long cycles. So what are we looking at here?
So the reason I brought this up is people are looking, like you made the point, people are looking at bond yields and saying it has to go up, it has to go up. And it kind of like, if you go back exactly a decade, there was a time when bond yields were so low that people were saying that yields have to go higher. And this was the time when a lot of debt in Europe traded at negative yields. So 2015 was the year when Austria issued a 100-year bond. Now that's absolutely crazy to think about, because will the country even exist in 100 years? Will the central bank, will the whatever is the new government, will they honor their commitments? Of course not. Most likely not. And even crazier, Argentina issued 100-year bonds. And Argentina is a country which defaults on its debt every 10 years. So you had all this craziness going on. And you had Nestle, the moment they issued the bond, it traded at negative yield. So you had quite a few companies, European companies, actually issuing debt at negative yield. You had US companies going over from the US bond market to borrowing in euros because the yield was so low. Now, in that environment, so you had, it was crazy. And obviously, it couldn't last. Like anyone looking at fundamentals would say negative yields on debt, that is, I lend you $100, I get back 99 in 10 years, 20 years. That's a terrible deal. I'll just keep the cash or not take the deal at all. So it sounds crazy. It was crazy, and it gets even crazier. So there was this bank, Danske Bank in Denmark. they issued negative yielding mortgages, meaning you take out a mortgage for the first year, they were paying you money, they were paying you interest for the privilege of giving you a loan. So, absolute nutty scenario. And in that scenario, Bill Gross, who was the head of PIMCO, he came out and said that the shorting the German bonds is the shot of a lifetime because it cannot get any crazier. I'm calling the bottom and all that. And what happened next was he was wrong for the next 4 years. So that's the chart I have on the next slide, where yields just keep going lower and lower and lower and proving him wrong. So the shot of a lifetime would have taken until the COVID crash to start working. Now, who can hold for that long? Now, you're absolutely right. The fundamentals said bond yields were higher, but for the first 5 years, they were lower. And then for the next 5 years, they were higher. So, can it go higher for the next 5 years after this? If you say that this is the bottom, yeah, it can. So, even if you're an expert at calling the fundamentals, calling the macro, whatever it is, when a move is this strong, there is no telling how long it can last. So, it might be crazy, but just as negative yielding bonds, buying those things worked from 2015 to 20, not buying bonds, no matter how attractive the yield, works from, let's say, 2025 to 2030. So that's why I say bonds have long cycles, because uh, unlike stock traders, like you have meme stocks and all that, bond guys are hardcore math guys. They look at the math, they look at matching their assets to their liabilities. So you have this issue going on now with these Taiwanese insurance companies, where they have issued a lot of policies for which they have to pay Taiwanese dollars, and they have taken the policyholders' money and invested it in USD debt. Now, when the Taiwanese dollar strengthens or US yields increase and they make losses, they have an asset liability mismatch and they have to balance their books. So, bond math is dealing with players like this who have assets in bonds in one currency, liabilities in another currency, or maybe liabilities in the same currency but in a different duration, and they have to match all of this. So these are very, very sophisticated players, and when these things trend, they make their decisions accordingly, and they're not going to just change at a heartbeat. So it took until the COVID crash for, and maybe even beyond the COVID crash, for the bond market to realize all this money printing is going to make inflation go up. And that's what kickstarted the current cycle. And we are badly in it. So I don't think this changes anytime soon.
Yeah, I think what's very interesting is, when these hit zero, there was this the move started to move higher once again. And then it broke down once again. That was 2018, and basically we started to get this downtrend. And what's funny to me, and I always bring this up, is the fact that trend followers were the only people still long this thing, because there was nobody in the world who was like, everybody was like, okay, I can't go past zero, it's got to stop at zero, okay, negative this point, it doesn't make any sense. Like you said, like, you're getting paid for taking out a mortgage, like, it just doesn't make sense at a certain point. So logically you'd go, okay, this has to stop. And the answer was no, it doesn't have to stop. It can go a lot lower. And it's the same with, the oil trade. Like, you don't know where things end up sometimes. And I think it's the same thing today, where I don't know where exactly. Like, number one, the biggest thing that I know about myself as a trader is that I don't know shit. I follow the price, I follow the probabilities. When I talk here and I have a lot of conviction, it's because I have conviction in my models, my systems, and the probabilities. But there's no probability that says, Jason, you will be 100% right on this. That's the thing you have to understand about every single trade. So there's always that possibility that something else can happen. But the probable bet still for yields is higher on the long end. Sure, the short end is going to go lower. The long end can go higher. The long end can go higher while the short end goes lower. A lot of people are disagreeing on that, even though it's happened last year. It continues to happen this year. I don't understand why, that's even a debate anymore, but that can happen. So they could lower rates and we could see this thing start to take off, and then energy could go right with it. I think the chart that I had earlier just like really says it all, which is, if energy is going to break out after this long consolidation and bonds are going to break down after this long consolidation, That's the environment where we start to see energy take off, and probably start to see the commodity cycle really take off as well. We've seen a lot of these softs go over the last couple of years, whether it was cocoa had a crazy run, coffee had a crazy run, orange juice had a crazy run and gave it all back, but it had a crazy run at one point. And then if you go over to the other end and you look at cattle's gone crazy. Lean hogs look great. Feeder cattle look great. And then you get to gold. Gold looks great. Still looks great. Silver looks great. Platinum looks phenomenal. Palladium's starting to move. It's going up and down because it's not exactly a precious metal, in my opinion, but it goes up and down, but it's starting to move. We're starting to see steel stocks bottom out. Metals and mining are bottoming out. All over the world, metals and mining look even better than the United States. So I'm just saying everything looks set up for higher yields, and just a completely different environment than people are ready for at the moment, which is kind of the reason why we talk about this so much, which is I don't think a lot of people are ready for this environment. So we talk about it a lot because it will get you ready for it. Kashop and I have made a lot of money over the last few years just because of the environment changing so much and so many people not understanding. That's what we do well, understanding the macro and then tying it into the ways we trade. So getting here, so there's a couple questions. So you think an ascending triangle in TLT will break down lower? It would be yes. Descending. Is there any particular trade on bonds you would do, or just focus on other commodities? So that's a great question. So I think for myself, the way I'm looking at this and the way what we keep laying out is that whether you want to sell bonds, I'm short bonds, but part of the reason why I short bonds is I like to be diversified. If I can be, and not to mention I have futures, so I have a lot more leverage to it. But if you're going to just be buying TLT or selling TLT, I don't think the money's really there. I think you want to start to look at the energy sector. I think the energy sector would be where the outperformance is if this breakdown happens. If it breaks up, let's say like it just stays in this range or it just, fools everybody. The market could do that too. It could just stay in this range and everybody could go, look, it's up, it's doing great. And then I'll go, look, it's down, it's doing terrible. And we'll just kind of go back and forth over that for a while. In that environment, I think gold miners will be the best trade. I think that's the place you want to be more than anything if yields stay around the same zone. But yeah, what's up, Wavy? Good to see you in the chat. So real fast, we've got about 15 left. So I wanted to bring this chart up because everybody also is bringing up the fact that the dollar has to move with yields and so on. And my point when we talk about any type of intermarket analysis and correlation analysis is that correlations change over time. So this massive downtrend in the 10-year yield, like what are we seeing? Did the dollar follow it completely? No, there's been times where bonds are going down, bond yields are going down, and the dollar is going up. So I'm drawing that on the screen like you guys can see that. Sorry, I mean here. So there's times where all of a sudden the dollar bottoms out, starts moving up, and yields are continuing to move down. That there's plenty of times where that happens. You'll see the correlation becomes low. There's plenty of times where the correlation becomes high. There's times where it becomes low again, and then it's high again. So, most of the time things are cyclical. And that's the one thing you can understand from this chart. It's not the fact that I know where the correlation will be in 6 months. It's the fact that when correlations are high, they go to low. Correlations are low, they go to high. Correlation was high for a long time. I think that's going to shift. I think that shift's going to be dramatic. And I think that's a situation where we see oil and energy start to move higher with this yield. So this is the 10-year yield. So oil and energy start to move higher. The dollar continues to move lower. And that's the environment that we usually see in a bull market for energy stocks. So today I'm really kind of outlining the fact that I'm getting very bullish on energy. I'm not saying like, hey, go buy all the energy stocks, are going to make all the money in the world. I'm still saying watch the price action, take the trades as they come. But the way the intermarket analysis looks, the way the macro analysis looks, it all looks like we're probably headed to higher prices. And you brought some great charts higher energy prices. You brought some great charts for about energy, and I saw these, and you sent these names to me. So I don't dig as deep as Kashop does. Kashop can find some real gems in the market, something he does great on his channel. So if we're looking at this one, Woodside Energy, see this huge move in it from the 90s all the way till basically the peak in oil in 08. So what are we looking at here?
So Woodside, it's an Australian company. They were one of the pioneers of LNG liquefaction and export. So they built, I think, in collaboration with Shell, they built Australia's first terminal, and it's a company with a lot of moving parts. And what's happened recently is investors have just shrugged it off, and that's because Australia has become pretty hostile to LNG, pretty hostile to oil. Same case with the UK. And out of desperation or management shift, let's say, what they did was they acquired Tellurian, which is a LNG developer in the US. Now they renamed it Driftwood. I forget the name, Driftwood LNG, and then they got some backers and they are building that up. And investors are kind of starting to forgive them. So that's why you're seeing this move. I think stock is back to October 2024 level. So, really good company which hit really hard times and then had to take some desperate measures to come out of it. But if they do succeed in coming out of it, then this is the kind of stock where you will find alpha to XLE, alpha to the overall energy sector. Now, there's another stock which I want to talk about, which is like a YOLO trade. Now, YOLO trades, of course, I don't recommend them. I'm just pointing it out because a YOLO trade in the energy space has already started working. It's gone like a hockey stick. Now, you do not find this kind of risk on appetite for YOLO trades in the energy space. And I keep saying YOLO because I don't want someone to take this clip out of context and say, this guy is recommending, small cap shitty companies. No, it's not a small cap shitty company. So this company, what they're doing is they are exploring for oil in Argentina. And it's not exactly Argentina, it's the Falkland Islands, which is off Argentina. And that island in particular, so the UK claims sovereignty over that island, even though it's quite close to Argentina. Now, Argentina also claims sovereignty over the island, so that's up in dispute. So they are exploring for oil in disputed waters. It does not get any more YOLO than this. Now, if Argentina wins, which is like a very slim chance, then this company is probably going to go to zero. Now, if the claims are in good standing and the case is resolved and the UK asserts its sovereignty and things progress in Argentina as well, maybe there's an amicable settlement, then this becomes even more of a hockey stick. Now, a company of this nature, usually it's priced like an option. Now, when investors are overly pessimistic about the commodity price environment and the outcome of the geopolitical issues, it's going to be priced extremely low. When investors are extremely optimistic, the price is going to kind of go like a hockey stick and trade at a huge uh, valuation, which discounts all the future possibilities. Now, rock hopper exploration is somewhere in between, but it is a clear sign that the investor appetite for taking risk in the oil sector has come back. Now, you're not going to see investor appetite manifest in stocks of US shale or all the typical companies that you look at. But if you look at these micro caps, if you look at what's happening on some London listings, so this is OTC in the US because the primary listing is London. So if you look at what's happening on the AIM exchange, or you dare to go beyond uh, the typical exchanges we look at, and you look at the ASX, you look at, let's say, the Hong Kong exchange, you look at all the other exchanges, you can spot a lot of these moves. And that's really also talking to the fact that this is an international equities rally. So international stocks, and I don't mean buying the Vanguard Total Stock Market ETF. I think if you buy that, you're buying 30% US, 20% Europe. So you're not really buying any of the outliers. You're just buying the market there again. So if you look at actual international equities, you can find a lot of outperformance. Now, this is great for active managers like me because, well, if I just tell you buy this ETF, buy that ETF, call it a day, then what's the purpose of my existence, right? So I find you these good opportunities where you can beat the returns that you would get just being passive. And more importantly, the day passive stops completely working, you will be prepared because you have the knowledge to go search for these companies. And that knowledge beats listening to the Vanguard marketing message, which is just buy this ETF all day and you'll make money. And it's not even true, like if you look at what Vanguard offers, they offer so many actively managed ETFs. Now, if they really believe that SPY or the other uh, S&P 500 ETF is the best in the world, why do they offer so many products? Well, they offer so many products because there's a demand for all those products. Now, it's the same thing with active investing. Active investing, everyone's kind of given up on it, but there's a demand for it. And the reason for that is there is one day when all these so-called popular trades stop working. And just like we saw with bonds, just like we saw with those long-term charts, that's going to be a trend in itself. And at that point, energy investors, precious metals investors, the bond shorts, the all these trades that you would never have even looked at, those are going to go wild and we are going to make a ton of money. You're on mute.
That's the scenario we're in, I think. I think we're in this scenario. Wavy also pointed the fact that COPX just hit a new 52-week high. I think we're just in the scenario where like there's going to be some crazy things we're going to see in that market. I mean, Josh Young was on the other day. He invested in a lot of exploration, smaller energy names, and he was talking about the fact that his fund had a return of 1,000% from end of 2020 into 2022. So it's like, people forget like these sectors make a lot of money. Like, you don't have to be a futures guy like me and have the leverage and all that. Like, you can find stocks inside of these sectors. Even some of the ETFs are going to be huge. Like Ethan just mentioned, I like gold more than COPX. Now, this is something I want to bring up because it's the same scenario where, once again, this is why we do what we do well. I do not have any relationship with gold. Gold isn't going to keep me warm at night. It doesn't love me. I don't love it. I'm not going to marry my gold trades. I like gold. It's something that I think is a long-term hold for wealth. It's great. But as a trader, I don't have any allegiance to gold. I have the positions. They look great. We're going to stay long. Nothing wrong with that. But that doesn't mean if copper starts to move, I'm not going to buy that as well. That doesn't mean if energy starts to move, I'm going to buy that as well. I think people in the especially in the United States, we have a lot of people who kind of think of everything as teams, Democrat, Republican. My team, my Ohio State Buckeyes are going to do this. Everybody has teams. And really it's like as a trader, you don't have a team. Your team is you. That's it. And your allegiance is to making money. Now granted, like, people feel like that's like some crazy thing to say, but like that is the truth. At the end of the day, like my opinions about where I think gold could end up in 2 years or where COPX could end up or where oil ends up doesn't matter as much as my returns at the end of each year. So be open to understanding like, hey, the gold miners are moving great. I want to stay in those positions completely right now. Yes, they look a lot better than COPX, but that's because they've been moving for years. So now if COPX is going to give me a 52-week high signal, I'm going to take that as well. And just continue. Not saying like that's the trade you need to take or the trade I'm taking at the moment. I'm just saying like just be open to the fact that commodities go through cycles. And gold is always the one that moves first and rings the dinner bell. And then copper is going to move next. And then most likely energy is last to come. So copper is making a new 52-week high. How long until energy makes a new 52-week high? It's probably right around the corner. And just one more to end on, just on the international theme, Shell Oil, 52-week highs. Almost, I mean, it might be at this point. Wavy, you could let me know. It might be hitting a new high already. So when we're looking at this, I'm just looking at the fact that international energy looks good. You brought up an Australian stock, like I'm bringing up a European one. I don't need like fundamentally, I'm not like Europe's great, you know, like I'm sure Kashop, I'm sure you feel the same way. Like I'm heavily long Europe right now. I don't think once again, I don't think I've said that or been that for many years. I had a trade in Greece in 2019. If I look through the portfolio, I can't see any other European ETFs or European countries that I've been investing in for years. So seeing this massive move in that, I want to continue to play that theme and go, okay, so what's next? Okay, if energy is going to move, it's probably going to show up in the international stocks first. And I think that's what we're seeing here with Shell Oil, new 52-week high. I think that could continue. I think there's a lot of things that look really good. Shell, BP, basically, if you go across the board on the big names over in Europe, you can see a lot of them. And then if you go through into Australia, there's a few. If you go into South America, there's a few. So, like, go around and find these and keep track of them. And don't be afraid to buy strength. I think a lot of people look at this and they go back to the XLE chart and they're like, look how much lower XLE is, or ExxonMobil, or any of those things. Really, like if you're looking for this, for what Kashop and I are both looking for this type of trend for, is a massive move. This should be in an uptrend for a long time. Like, you're not missing the move by buying it here because you missed it here. This is just a massive move, a massive setup that could be something that goes up 30, 40, 50 to 100%. And this is a big name. Kashop's out there. If you guys follow him, make sure to check out his pages. You guys can see, like, there's even smaller names that are going to go up 500 to 1,000%. So continue to be open-minded to the cycle, the way it's going to move. Got a couple minutes if you want to end on something, Kashop, but I'm all finished.
Yeah, I think Maybe made a point. Canadian oil looks amazing. So I agree. I completely agree. And Canadian oil is actually the hardest space in the oil sector to understand. So in that space, unless you're an expert, I would say just stick to the large caps, because it is incredibly hard. It is incredibly hard to understand the mechanics of all the producers there. But yeah, I agree that it looks amazing. I don't have any exposure to Canadian oil in the portfolio. And speaking of 500%, 1,000%, so right now I have two stocks that are up 3x, or up 2x rather. So I'm at 3x on those stocks. And one is a uranium / rare earth story. The other is a gold story. So it is completely possible. And it's not even like I had a huge, you time the cycle right and you buy in and you turn over a lot of rocks and you're patient and you're going to get there. And that's really the message. Like, you can buy the ETFs, sure, and you're going to get a great performance. I think GDX is up something like 70-80% this year. The copper miners, COPEX, is up something like 30-40% this year. So you're going to get great performance. Not that you're not, but if you're willing to do the work, read the financials, and most importantly, look at the charts and see what they are telling you, I think you can set up for even more outperformance. And let's say it's a 5-year cycle. In a 5-year commodity cycle, you compound at 10-20% additionally because you pick good stocks. That's going to make a world of difference for your retirement. So I think that's the message that I would end on.
CNQ versus Shell. I really like CNQ. Something in my retirement portfolio had for a long time. So I do like CNQ. Shell, just another trade. Fundamentally, do I love the company? Not that much, but it's just another trade. Short-term swing trade. CNQ is something that I think could be a big mover this cycle. But all right, guys, I got to run. Thank you guys for joining us. We'll see you next week, 10 a.m. on Fridays.